This is Macro Horizons, episode 330, The Download, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of June 30th. As Macro Horizons has officially reached the 1 million downloads milestone, that's in total, not per episode, we can only imagine how many sleepless nights we've prevented. After all, nothing causes drowsiness quite like a friendly fireside chat about U.S. rates. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the primary theme was monetary policy. We heard some dovish Fed speak, combined with speculation that Trump could nominate Powell's replacement very soon. The assumption would then become that the chair in waiting would garner more attention from market participants, as it would imply in June of 2026 a decidedly different and more dovish take on monetary policy. This sentiment led 10-year yields to 4.25, as well as 2-year yields closer to 3.70. When we look at the forward pricing for rate cuts, what we see in the Fed funds futures market is that the market expects the Fed to achieve neutral by roughly the September meeting next year, neutral here being defined as 3%. Now, that is a far quicker pace than the Fed's beloved dot plot just showed, where we saw the 2026 dot at 3.6%. Now, that 60 basis points divergence might simply be the premium for a more dovish Fed chair. It's difficult to envision in the absence of a recession or a more material shift in the direction of the labor market that we will so readily achieve what the market is currently pricing in. While we are generally constructive on the Treasury market, and we do see the path of least resistance over the course of the coming months as towards lower rates, we are beginning to view the 2-year sector as rich in the context of the prevailing market risks. That being said, the $69 billion of 2-year Treasury notes that were auctioned came slightly through with strong bidding stats, as did the 7-year. While the 5-year tailed modestly, overall, all 3 auctions had strong non-dealer participation numbers. This suggests, yet again, that there's no evidence of a buyer strike in U.S. Treasuries at the moment. Moreover, the broader strength in the Treasury market appears to be primarily a function of monetary policy expectations, as well as a slightly tamer economic outlook for the U.S. It's worth noting that Q1 GDP was revised lower, now down 0.5% for the quarter, but we all know that the story was a significant drag from negative net exports, as importers sought to get ahead of Trump's tariffs. What was somewhat surprising within the details of the GDP report was the downward revision to personal consumption. Once again, coming off of the strong initial print, personal consumption increased at a pace of just 0.5% on a quarterly annualized basis in Q1. This certainly suggests that the trajectory of spending could come under pressure over the summer months in the event that higher prices constrain real spending. That being said, our take remains that the biggest downside risk for the consumer won't materialize until we see a spike in the unemployment rate, which puts all the more focus on next week's non-farm payrolls print.
Well, it was the final full week of June, and in the Treasury market, there was no shortage of factors that drove 10-year yields back below 4.25, as the concerns around a reinflationary acceleration resulting from the events in the Middle East and what that means for oil prices have waned, and the general concern about a softer economic picture going forward has rematerialized, at least on the margin, as we saw the highest continuing jobless claims print since 2021, and, perhaps most importantly, a dovish round of Fed speak from Governor Waller, from Bowman and Powell himself in front of the House and Senate, who sounded a bit more cautious on the economy. And while the chair, unlike Waller, didn't explicitly say that a July cut is on the table, it's clear that despite what we saw in the dot plot, Powell is still very much of the opinion that it's going to be appropriate to continue bringing rates lower later this year.
And I think it's really interesting to note the divergence between what the market is pricing in and the dot plot. Specifically, the 2026 dot at 3.6 versus the market, which now has us returning to neutral, or 3%, by the September meeting of next year. This implies the assumption of a reasonably strong dovish bias from whoever Trump selects as the new Fed chair. We're not in the July rate cut camp, although the path towards a July cut isn't that difficult to envision. In the event that we see a spike in the unemployment rate and another benign CPI print, it's not difficult to envision a shift in messaging from the Fed. Also note that the second quarter real GDP numbers are released the day before the Fed announces its decision. Given the downward revision to personal consumption seen in Q1, questions have emerged regarding the trajectory of spending and what that could imply for growth between now and the end of the year. This represents a meaningful risk as we contemplate the prudence of positioning for a July versus September rate cut.
And away from simply matters of monetary policy, it was also an important week in the geopolitical sphere. The U.S.'s strikes on Iran last weekend really didn't bring any meaningful tone change to the market coming in to start the week, but now with the conflict seemingly on the path to de-escalation and a tenuous ceasefire in place, we suspect the volatility, particularly in the energy market, around what's going on in the Persian Gulf, will presumably shift to at least a marginally backburner issue for the time being. So that's a potential inflationary impulse that has moderated, at least on the margin, as we saw oil pull back from the highs it reached last week. Secondly, and perhaps more importantly, on the would-be inflationary impulse front, is the progress that we've seen in the negotiations between the U.S. and China on the trade war front, and while it's far too soon to say that all has been resolved, the headlines this past week from Secretary Lutnick suggest that meaningful progress is underway, and even if it's not going to mean tariffs are removed entirely, some sort of agreement will presumably at least add some clarity to the outlook and allow businesses and consumers to begin to have a little bit more conviction in terms of costs going forward. So another higher rate impulse that has been moderated and added to the buying we've seen in treasuries. Last but not least were headlines later in the week that the revenge tax initiative that was being floated in Washington, which would increase costs to foreign holders of U.S. investments, has been walked back, and another potentially bond-bearish dynamic, disincentivizing overseas ownership of treasuries, has been moderated. Take all that, and then the catalyst of Powell sounding a bit more dovish on Capitol Hill on Tuesday and Wednesday, and it was enough to bring rates back to the lowest they've been since early May, and the 5/30s curve back above that critical 100 basis point threshold.
The curve steepening that had been in place throughout much of this year was largely a function of pricing in the potential for greater issuance in 2026 and beyond, as well as deficit spending and the positive fiscal implications from this. Said differently, forward inflation expectations in term premium have been driving the backup in rates. The market appears to be shifting to the next phase of the steepener, specifically the leg in which monetary policy drives the move. And this implies a bull steepener led by the 2- and 5-year sector, which is precisely what we have seen. The fact that this week's auctions were all relatively well received, even if there was a slight tail for the 5-year, also reinforces the notion that we have yet to see any evidence of a wholesale buyer's strike in treasuries, and as we get further and further away from Liberation Day and the incentive to trade war headlines declines further, we're sympathetic to the impression that investors are ready to move on, as it were.
And that fatigue could also be seen in what we'll argue was a degree of capitulation for those expecting that everything that's been going on lately would push 10-year yields back above 4.75 or beyond. will characterize what started as seller's fatigue to more wholehearted dip buying, which can be seen via the OI expansion in FE and TY that we've seen over the past week, and anecdotally, the expectation that if 10-year yields are unable to cheapen meaningfully beyond 450, and similarly 2-year yields appear to be well capped at 4%, then given what we're starting to see in some of the labor market indicators and what we heard from the Fed this past week, maybe now is the time to increase duration exposure as we head into the more significantly slow periods of the summer. Interestingly, or perhaps relatedly, this has not come at the expense of risk asset valuations, and so calling it a flight to quality or risk-off move wouldn't be entirely accurate with the Nasdaq back at record highs, but rather will characterize the bullishness in treasuries as the fact that in any longer-term historical context, rates are still attractive, especially with the Fed continuing on its cutting path.
So don't call it a comeback. Bonds have been here for years. And in that context, the question then quickly becomes, how far can the market rally? All else being equal, it's not difficult to envision 10-year yields retesting 4.1%. However, it becomes more difficult to envision three-handle 10s given the fact that there are still supply concerns, term premium is well into positive territory, and the reality is that unless there is a sharp and decisive downturn in the pace of growth in the U.S., that Fed cuts will be preemptive and not reactive, thereby reinforcing the yield range for duration as opposed to triggering a wholesale flight to quality. At least that is our operating assumption at the moment.
And let's not forget what the dot plot revealed in terms of not necessarily the plan for rates in 2025, but further out in the shallower cut paths that were projected in 2026 and 2027. In our view, what this means is that the Fed still views monetary policy as moderately or modestly restrictive, and so that means another cut or two this year or early next is going to bring policy close enough to neutral that future cuts back to the long-run dot can take place over a much longer time horizon. Data dependent, of course. So as we think about the shape of the curve and just how far 5 and 10-year yields can fall, it's that flatter path around the assumption of policy rates going forward, and will be a difficult fight against the last mile of inflation that's probably going to remain relatively elevated in the context of the last 10 years, that's going to keep the pre-COVID or immediately post-COVID rate regime elusive for the foreseeable future. So while we probably have enough evidence that 5-handle 10s aren't going to be a near-term reality, nor is the global rates landscape changing in such a way that we're going to be back at 2-handle 10s probably anytime soon.
It's also notable that we have seen not only the Treasury Department, but other major sovereign borrowers become more market responsive or reactive to shifts in term premium and the push towards higher long-end yields globally. We've seen this from the Bank of Japan as well as in the UK. Sovereign borrowers have become comfortable scaling back or not increasing longer-dated issuance in response to market conditions. Translating this to what one should expect from Besant, we continue to anticipate that nominal auction coupon sizes won't be increased until the second half of 2026, and that the bulk of the borrowing will occur in the bill market. Even when coupon auction sizes are ultimately increased, it's not abundantly clear that that is going to translate into larger 20 and 30-year auction sizes. Certainly not significantly so. But there's a lot that can happen between now and the second half of 2026.
And along with what we heard from Besant even before he got the nomination for the Treasury Department around the idea of the shadow Fed chair that obviously came into the market discourse this week, that's very consistent with his view on the structure of the Treasury market and how issuance should be undertaken. Besant and Trump have talked a lot about wanting to keep 10-year yields low, given the influence that longer-dated yields have on actual economic activity, as opposed to overnight rates, and so the criticisms levied against Yellen around not taking advantage of the flatness of the curve several years ago still apply even in this steeper yield curve environment. And frankly, to the earlier point about the outright level of rates, bill yields above 4% still offer an attractive enough return to a wider variety of buyers that it's probably prudent from the Treasury Department's perspective to take advantage of higher demand for shorter-dated treasuries as a way to more effectively fund the deficit. Now, the previously offered guidance that bills should sit somewhere between 15 and 20% of the overall market has long since been de-emphasized. Bills have been above 20% of the overall market for some time now, and we don't expect that the August refunding, or frankly any refunding in the near term, is going to show a desire to bring bills back down as a share of the overall debt outstanding. So to circle back to the conversation that we were having earlier, another potentially bearish impulse in terms of larger long-end auction sizes that probably will not be coming to pass and serve as another reason that reinforce our generally constructive take on treasuries, maybe not from exactly these levels, but certainly over the medium and longer term.
So this begs the question, what happens when the bills come due?
You just make more.
And more.
And more.
And more. In the week ahead, we're expecting that the shortened trading week will be volatile, if nothing else. The week starts with month end on Monday, which, while at 0.07 years, the index extension isn't particularly high, should nonetheless support the longer end of the curve, particularly given the ongoing demand for treasuries at auction, as well as the prevalence of meaningful geopolitical risks. We then hear from Powell on Tuesday, as well as getting the ISM manufacturing data. In addition, we see JOLTS, followed by Wednesday's ADP print, which, recall, was particularly weak for the month of May. This will leave investors somewhat dubious in their approach to ADP for June, given that the weakness seen in May's ADP print didn't translate through to the official BLS data. And of course, the release on Thursday of the June payrolls print will be pivotal for monetary policy expectations for the next several quarters. There are investors in the market who are positioned for a 25 basis point rate cut at the July meeting. We're not in this camp. We suspect that July is the first truly live meeting, and after all, between now and the September meeting, the Fed will have the benefit of the July and August CPI prints, from which to evaluate the degree to which the trade war has or has not flowed through to realized consumer prices. The one caveat is that if we do see an unexpected spike in the unemployment rate in June, as well as another benign June CPI print, then a 25 basis point rate cut could be on the table for July. The market's current pricing implies a 25% probability of a quarter-point cut in July. We'll argue that that's probably fair, all things considered, and appropriately prices the risk of a downside surprise on the employment front and another moderate inflation print. Although in the absence of this particular perfect storm, we'd expect that the front end of the curve would cheapen somewhat, and we'll also be watching average hourly earnings for any updated context in realized nominal wages. Keep in mind that Thursday is a recommended early close and Friday is a full market closure for Independence Day. In addition, the second week of July sees the expiry of Trump's tariff pauses. As a result, we wouldn't be particularly surprised to see more headlines from the White House indicating either a willingness to extend the pause or an uptick in the trade war rhetoric as the deadline quickly approaches. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. With 1 million downloads and 330 episodes now behind us, a commemorative coin seems in order. Perhaps a macro coin. Nothing says stability like crypto. Instead, we'll focus on revisiting the audio department for a less angst-inducing disclaimer. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.